Welcome to Have You Read It, the channel where we bring books to life one summary at a time. Today we're tackling John C. Bogle's investment classic, Bogle on Mutual Funds: New Perspectives for the Intelligent Investor. This isn't just a how-to guide, it's a philosophy, a critique of the industry, and a roadmap to long-term financial success. Get ready for a deep dive, because we're going to unpack this book thoroughly. First, let's set the stage. The book, originally published in 1993, has achieved classic status, as evidenced by the glowing endorsements it received from luminaries like Warren Buffett. This is the definitive book on mutual funds: comprehensive, insightful, and, most important, honest. Peter L. Bernstein. This book sets the ultimate benchmark for all how-to-invest books. I would choose it even over Benjamin Graham's The Intelligent Investor, and even Nobel laureate Paul Samuelson, who wrote the foreword. Bogle's own introduction explains how the book came to be, initially spurred by an editor's persistence and later fueled by Bogle's own reflections on his mortality. The book's enduring relevance is a testament to its timeless principles. Bogle begins by establishing the foundational elements of investing: rewards and risks. Chapter 1 lays out the potential rewards, emphasizing the magic of compounding. He uses historical data, stretching back to 1872, to illustrate the dramatic long-term growth achievable through consistent investment in stocks, bonds, and cash reserves. He breaks down stock returns into their components: initial dividend yield, dividend growth, and changes in the price-to-dividend multiple, highlighting the unpredictable nature of the latter. For bonds, he emphasizes the crucial role of the initial yield and the reinvestment rate. He clearly states that past returns are not necessarily indicative of future performance. Historical evidence is vital, but should be treated cautiously. Following the rewards, Chapter 2 dives into the risks. He starts with inflation risk, its erosion of purchasing power, and its impact on real returns. Then, he moves to risks specific to different asset classes. For stocks, he examines total return risk, principal risk, and income risk. For bonds, he discusses total return risk, influenced by interest rate changes and maturity, principal risk from interest rate fluctuations and credit risk, and the relative lack of income risk for high-quality bonds. He also elaborates on the concept of duration and call risk. Finally, he analyzes the risks of cash reserves, primarily the volatility of interest rates. Having laid out the theoretical groundwork, Bogle moves on to mutual funds in Chapter 3. He outlines the 4 basic principles of successful mutual fund investing: broad diversification, professional management, liquidity, and convenience. He also discusses the practicality of selecting a fund complex, emphasizing reputation and the importance of understanding a fund's annual report. He addresses the issue of mutual fund performance, explaining the differences between cumulative and annualized returns and the need to compare like with like. He warns against over-reliance on past performance and introduces the concepts of X-mark, beta, and gross dividend yield as tools for analysis. Now we get into the meat of the book: mutual fund selection. Part 2 dedicates 4 chapters to different fund types. Chapter 4 explores common stock mutual funds. Bogle categorizes them into growth, value, equity income, broad-based specialty, and concentrated specialty funds. He emphasizes the importance of understanding a fund's investment style and the limits of predicting future performance based on past returns. He cautions against over-reliance on past performance and introduces tools like X-mark, beta, and gross dividend yield for comparing funds. He also discusses structural characteristics such as fund size, age, manager tenure, cash position, portfolio concentration, market capitalization, and portfolio turnover. Chapter 5 turns to bond mutual funds. Here, Bogle highlights the diverse types of bond funds available and the importance of understanding their portfolio characteristics such as quality, maturity, and the use of derivatives. He warns against prioritizing current yield over total return and emphasizes the impact of expenses on yields. He stresses the importance of considering credit risk and prepayment risk as well as total fund costs. Again, he underscores the limited predictive value of past performance and emphasizes the importance of comparing funds with similar characteristics. Chapter 6 covers money market funds, their relatively low risk and high income risk, and the importance of considering portfolio quality, yield, and expense ratios. He explains how recent SEC regulations have increased homogeneity in this sector, but cautions about hidden yields and the temporary nature of fee waivers. He also discusses the tax implications and compares money market funds to short-term bond funds. Chapter 7 discusses balanced mutual funds, their inherent blend of equity and bond holdings, and the need to understand their investment objectives. He categorizes them into equity-oriented, income-oriented, and asset allocation funds, highlighting the differences in their risk and return profiles. He provides the same criteria for evaluation, emphasizing portfolio balance, bond characteristics, and costs, and reminding listeners that past performance isn't a guaranteed predictor of future success. Part 3 shifts to 3 crucial, often overlooked aspects of investing. Chapter 9 makes a compelling case for index funds. Bogle explains the efficient market hypothesis and how indexing, by design, matches the market's return while incurring lower costs. He presents historical data showing index funds consistently outperforming actively managed funds in the aggregate, and illustrates how seemingly small differences in annual returns can translate to massive differences over time. He addresses criticisms of indexing and explores the evolution of indexing strategies, covering total market index funds, mid-cap, small-cap, and international indexes, as well as style indexes. Chapter 10 explores the substantial impact of costs. Bogle meticulously breaks down mutual fund costs into sales charges, expense ratios, and the often overlooked transaction costs. He highlights the importance of considering the total cost of ownership, not just the expense ratio alone. He powerfully illustrates the significant long-term impact of even seemingly small cost differences. He again emphasizes the need for thrift and low-cost investment choices. Chapter 11 tackles taxes. Bogle shows how taxes significantly reduce investment returns, highlighting the importance of understanding the tax implications of different investment strategies, such as dividend reinvestment versus cash distributions and high versus low turnover portfolios. He explains special tax considerations for mutual funds, including the impact of capital gains distributions and the importance of knowing the cost basis of your shares. He discusses strategies for tax deferral, including IRAs, 401k plans, and 403b plans, and contrasts those options with variable annuities. Part 4 moves into the practical application of the book's principles. Chapter 12 focuses on asset allocation, emphasizing the importance of this decision in determining overall investment returns. He suggests a 50-50 stock-bond allocation as a starting point, adapting it based on age and risk tolerance. He discusses the benefits of dollar cost averaging and the importance of rebalancing, and then explores tactical asset allocation, emphasizing its inherent risks and the need for caution. He further presents a model for predicting long-term returns based on dividend yields and interest rates. He concludes by showing how minimizing costs can enhance returns without increasing risk. Chapter 13 presents 8 model portfolios demonstrating various asset allocation strategies for different investor types: accumulation, transition, distribution, lump sum, and institutional investors. These portfolios provide concrete examples of the principles discussed earlier, demonstrating how to choose specific fund types to achieve desired asset allocations while considering age, risk tolerance, and investment objectives. He highlights the advantages of index funds and the importance of keeping costs low. The final chapter, Chapter 14, is a powerful call to action for mutual fund shareholders. Bogle argues that the responsibility for improving the industry lies with the investors themselves. He encourages investors to be canny, thrifty, active, and skeptical in their investment decisions. He discusses the importance of exercising voting rights, expressing opinions to fund management, and demanding transparency and candor in fund reporting. He emphasizes the need for independent directors to uphold their fiduciary duties and calls for structural changes within the mutual fund industry to better align the interests of management companies and fund shareholders. The epilogue concludes with 12 pillars of wisdom, concisely summarizing the book's core tenets. These include the importance of simplicity, time, diversification, cost consciousness, understanding the eternal triangle of risk, return, and cost, recognizing the power of regression to the mean, avoiding fighting the last war, and the futility of trying to outsmart the market, advising investors to think long-term and stay the course. So, what's the main takeaway from Bogle on mutual funds? It's a powerful argument for long-term, low-cost investing. Bogle dismantles the notion that consistently superior returns can be achieved through active management, highlighting the consistent outperformance of index funds in the aggregate and the crippling effect of high fees. He champions simple, diversified portfolios tailored to individual circumstances, emphasizing the significance of asset allocation and cost management over attempts to time the market. Here are some easy-to-remember heuristics from the book. Keep it simple. Time is your friend. Costs matter. Diversify. Don't try to time the market. Be informed. Be active. Thanks for watching. Make sure to give this video a thumbs up and hit that subscribe button so you never miss our next book dive.